Hi CA students, let's revise CA Final AFM Chapter 5 Security Valuation. Practical question 27. Mr. A will need 1 lakh after 2 years, for which he wants to make one time necessary investment now. He has choice of two types of bonds. The details are below. Bond X, bond Y. Face value is given and then the coupon rate is also given. Years to maturity for bond X is 1 year and then for bond Y is 4 years. Current price of bond X is 972.73 and bond Y is 936.52. Current yield, so yield to maturity of bond X is 10% and for bond Y is 10%. Advise Mr. A whether he should invest all his money in one type of bond or he should buy both the bonds, and if so, in what quantity. Assume that there will not be any call risk or default risk. Okay, now going to the question. Here the situation is of Mr. A has having a amount of 1 lakh and then in which investment he should buy. So the main consideration here will be based on the duration of the bonds. Why? Because duration will give us the uh, recovery of the investment at its true cost in terms of years. So within how many number of years we will recover the true cost of the investment. And here we since Mr. A is going to make one time necessary investment and his option is to invest all the money in either one of the bond or in both the bonds, and we have to tell Mr. A how much he should invest in terms of quantities, and he is needing that investment after 2 years. So he requires that 1 lakh after 2 years. So how much he should invest in bond X and bond Y, or either in bond X or either in bond Y, so that he will get that 1 lakh after 2 years. So duration helps us to calculate the recovery of that amount, but it will be like a reverse calculation sum. So for bond X and bond Y, first we have to calculate the duration, then based on the duration of bond X and bond Y, we have to decide how much or in what proportion we have to invest in bond X and bond Y. Okay, let's directly go to the problem. The duration of bond X, since the year to maturity is just 1 year, so even if we calculate duration for bond X, it will come up to only 1 year, because as there are not multiple years to give weight for yearly proportions to arrive at the duration. Since it is 1 year, the duration of the bond also will be 1 year. In case of bond Y, the years to maturity is 4 years. So we have to assign weights to each years based on the present value. The cash flows of bond Y are: coupon rate is 8%, so 8% into 1000 will get 80 rupees, which is the interest which bond Y is giving for 3 years. For 4 years, then the redemption, here it is assumed it will be on par basis, so redemption 1000 rupees at the end of 4th year. Discounting it with 10%, we are getting a PV of 936.52. Now we need the proportion of this bond values to calculate the duration. So we have the PV for every year. Then if we calculate the proportion, like 72 point in case of first year, 72.72 divided by 936.52 will give us the proportion of bond value in the first year. and in the second year same 66.08 divided by 936.52 will give us the proportion of second year present value cash flow. Going further to fourth year where the majority of the cash flow is happening, so 737.64 0.788 will be the proportion. Now in case of duration we have to assign yearly weightage, right? So this proportion will get multiplied with the years, and that will be 0.07 and then 0.142, 0.192, 3.152. As we can see, as the year goes further, the more weight is given for the later years. So arriving at a duration of 3.563. Now we have duration of bond X and duration of bond Y. As per the requirement of the question, as we can see, we need the Mr. A will need the amount after 2 years. So we need to invest in a proportion that the resultant will be 2 years. So the formula will be 2 years equal to weight of bond X multiplied by duration of bond X plus weight of bond Y multiplied by duration of bond Y. Here we have only two options. So if we invest 10 percentage, let's say if we invest 10 percentage in bond X, then the bond Y it will be 90 percentage. If 20 percentage in bond X, then 80 percentage in bond Y. So let's say if we are keeping weight of bond X as X1, then 1 minus X1 will be the weight of bond Y. If we multiply with the duration, then keeping 2 years as the duration for our investment, we can get at what proportion we should invest in these bonds. So reverse calculating, in case of X1 the duration is just 1 year, so multiplying with 1 will get the same result, and in case of Y, which is 1 minus X into 3.563, then reverse calculating, we are arriving at X1 value as 0.61. So the proportion of investment for X1, which is bond X in our case, will be 61% and 39%, which is the rest, will be in bond Y. Now we know at what proportion we should invest. Now we should calculate what the amount of investment to be done in both the cases. So PV of we need 1 lakh, right? So 1 lakh for 2 years at discounted at 10% in case of bond X, and in Y also it is 10%. So 10% multiplied by the proportion 61% as we calculated, and 39% in case of bond Y. Calculating, we are getting a present value of 50,386 in case of bond X and 32,214 in case of bond Y. So this much investment has to be made in bond X and bond Y respectively to get a value of 1 lakh after 2 years. Now we need to purchase shares, right, today, so that this bond will give us the yield of 1 lakh after 2 years, correct? So the current price of the bond X and bond Y has been given. So 50,386 divided by the current price of bond X will give us the number of bonds to be purchased, 52 bonds in case of bond X, and 32,214 divided by 936.52, which is the current price of bond Y, will give us the number of bonds to be purchased in case of bond Y, which is coming approximately around 34 bonds. So this much, like 52 bonds has to be purchased of bond X and 34 bonds has to be purchased of bond Y, so that this proportion will give us a yield of 1 lakh after 2 years. Now we have to keep in mind that the investor has to keep the money invested for 2 years, as the duration is 2 years. If he keep it invested for 2 years, then only he will get the return of 1 lakh. after 2 years. So in the current case, the maturity of bond Y is 4 years and maturity of bond X is 1 year. In Y there will not be an issue, so we will keep the bond till 2 years. But in case of bond X, it will get matured within 1 year only. So it is assumed that we have to reinvest again to get the yield of 1 lakh after 2 years. Therefore, the investor can invest in both the bonds with the assumption that bond X will be reinvested for another 1 year on same returns. And here we have taken the approach of duration. To get more accurate results, we can follow modified duration, because it will give the exact interest rate sensitivity, more precise answer than duration. So if we go with modified duration approach, then whatever we calculated as duration, which is 3.563 in the case of bond Y, we will be dividing it by 1.01. So we are getting a value of 3.238. So 3.563 divided by 1.1 will give us 3.238, which will be the duration of bond Y. This will be for bond Y. Similarly, we have to find for bond X also. So in bond X, it will be 1 divided by 1.1 will give us 0.909. So in the formula, actually this is wrong, because we have to multiply it with x1, the proportion of bond X, multiplied by 0.909, which is the modified duration for bond X, and bond Y it will be 1 minus x1 into 3.238. So if we get the answer, then that will be the proportion which will get substituted here, and then the same divided by current market price will give us the number of bonds to be purchased in case of bond X and bond Y. So that's it. Thank you.